Good day, everyone. This will be our second part discussing about considering internal control. And this is our fourth or number 4 objective. Obtain and document an understanding of internal control. So we have to understand what IC is all about, and then we have to prepare documents to record such understanding. So for this, we have to recall about the process for understanding or comprehending, or of course eventually we'll be analyzing internal control and assessing control risk. So the figure here 10-3 shows that phase 1 is what we have mentioned a while ago, including the design and operation. Phase 2 is to assess the risk, control risk. Phase 3 is to design, perform, and evaluate the controls as being discussed above in phase 1, and we have to evaluate them. So we perform the tests of controls. And finally, in phase 4, we decide the planned detection risk, which is the risk that the auditor will manage given the inherent risk and the control risk. And then, of course, to add or reduce the substantive tests depending on the assessment of the internal controls, as well as, of course, the effectiveness, that's very important, and efficiency of those controls. In obtaining and documenting understanding of IC, auditing standards would require auditors to obtain. So this is really a requirement to have that understanding of IC for every audit. The procedures here below are the ways to which we can obtain an understanding. So we do inspection. So we look into the controls that are in place, whether that's physical or logical. Logical stands for intangible. Or we can also inquire entity personnel involved in those ICs, or observe how employees would do or perform such procedures. To document, we have 3 common methods used. We have the narrative in the form of paragraphs, flowchart in the form or with the usage of symbols, in which each symbol has a meaning, and then questionnaire, normally a yes or no question. For the narrative, so we can see there the origin, the point of the starting of every document and record in the system, the processes that are involved, how the documents are being disposed of, and the record in the system, then an indication of the controls relevant to the assessment of control risk. So this is what we will get here. For evaluating internal control operation, we can do the following. In fact, some of the items here have been mentioned already, like the second, third, and fourth. The first is to update and evaluate auditors' previous experience with the entity. It's possible that this is a continuing audit, meaning to say this is our second and so on number of audits. Normally, we are allowed to perform up to 5th year, and then we have to change our clients, or our clients would also change their respective auditors. So if this is a continuing audit, normally you're already aware of certain internal controls present, and perhaps there are additional or improvements that are there. So we also have to document them or take notes of them. And the 5th one is perform walkthroughs of the accounting system. We are going to act as if we are part of the client, we are part of the system, and then we are going to do the procedures and check if ICs are working effectively and efficiently. Then the 5th objective is to assess control risk by linking key controls and control deficiencies to transaction-related audit objectives. So remember our management representations or assertions by the management with respect to the transactions. So we have to know the controls that are available and should be available, and the deficiencies. So the reasons that these controls are not working. For assessing control risk, this would involve assessing whether the financial statements are auditable. So given the situation of the client, can we really do the audit? Or do we have scope limitations? So because of the client situation, we cannot really perform the audit. Then we determine assess control risk supported by the understanding obtained. Whatever we have assessed or our assessment results, then that should be supported. And we use this control risk matrix to assess the control risk, and that will be shown later on. Then many auditors use the control risk matrix to assist in the control risk assessment process at the transaction level. The control risk matrix will be very specific as to what shall be done. Then this would involve identify audit objectives. What are our purposes in doing the audit, the existing controls, then again, controls with objectives, and the link of these controls and objectives to identify and evaluate the deficiencies of controls, significant deficiencies, and material weaknesses. Then here is figure 10-6, showing us evaluating significant control differences. So we can see here on the x-axis the likelihood, y-axis would be the significance. So if the likelihood is reasonably possible, and then materiality, or in terms of materiality, that's significant or material, then that control deficiency is a material weakness. And then if all other else, like remote likelihood but material, that's not going to be a material weakness. Or immaterial and remote, the more reasonably possible but immaterial, not. So only when it's reasonably possible to happen or to result to material misstatements, and then significance would be material. So that's our guiding factor for us to say that the control deficiency is significant. Then to identify deficiencies and material weaknesses, we also have to know, number one is already known, then absence of the key controls. What are the ways for us to be able to at least alleviate the effect of the absence of key controls by compensating controls? And we have to decide whether there is a significant deficiency, as shown a while ago, or material weakness. And then determine potential misstatements that could result there. Now, we also need to communicate our audit findings to those charged with governance, especially with significant deficiencies and material weaknesses, to the audit committee. Remember, the ruling is that, or the procedure is that, the board of directors should have an audit committee, normally composed of 2 to 3 people who are independent from the others. And then this particular communication should be in writing. Next would be management letters from the auditor. So auditors must secure the management representation that they are primarily responsible to whatever has been audited, especially for financial statements audit. Then less significant control weaknesses for us to be able to say that at least we will not be declaring that the financial statements are not fair. So that would be adverse opinion. And then ideas for operational improvements. How can we improve the operations of our clients? Then the sixth objective is to describe the process of designing and performing our tests of controls. So tests of controls would be the procedures to test the effectiveness, and this would include also efficiency of controls in support of a reduced assessed control risk. Then the procedures would involve the following. We have mentioned actually a while ago inquiry. This one, examination of certain documents, records, and reports. Then we observe control-related activities. And this one is what is unique here, reperformance of client procedures. So whatever procedures there of our client, we can reperform and check if they are really effective and efficient. Then extent, meaning is how deep our auditing and examination of documents, for example, or investigation or inspection would be. So the extent would be dependent on our reliance of evidence or on evidence from prior year's audit. So if we rely high on the evidence from prior year's audit, therefore, we can perform a little in the current year. Then testing of controls related to significant risks would be important, such that if we have evaluated and tested prior and then evaluated later on that the controls are, of course, effective and efficient, so we can minimize the procedures that we are to perform. And testing less than the entire audit period, if that is the case, so it depends upon our assessment of that though. Should we increase because our entire audit period is not covered, but normally that would result to an increase of procedures. All right, so the relationship of assessed control risk and extent of procedures, our assessment, and then how deep again, how big our procedures to be done. So type of procedure, for example, is inquiry. The assessed control risk is high level. Procedures to obtain, by the way, an understanding of control. So that would be extensive. Inquiry has to be extensive since the control risk, meaning to say the risk that the internal controls present or existing of the company cannot detect material misstatements. If lower level, the test of controls would be some. So some inquiries have to be done. Now for inspection, if high level, so the procedures to obtain an understanding would be, it would be a walkthrough, has to be involved. So we are going to perform the transactions or observe later on for the transactions. That's why it is with walkthrough. But if lower level, the test of controls will be using sampling only. So for the inspection, we don't have to perform the majority, but only samples to represent the population. Observation for lower level tests of controls, then we're going to, by the way, the control risk is low, so we can perform it at multiple times. For reperformance, if high level, so no need to reperform because again, it's not going to be reliable. And then for the test of controls, we will use sampling if it is of lower level. All right. Next is that we design, plan, detective risk, and design substantive tests. So we can see here the relationship control risk assessment process results, which is prior to the PDR or plan detection risks. And the parallel for the previous would be tests of controls, while by detection risk, we can now, of course, manage whether we increase or decrease our related substantive tests. Then we have here the control risk assessments based on the left side, and then the right side would be the substantive or substantive tests related to balance related audit objectives. And then for section 7 or objective 7, which is to understand section 404 requirements for auditor reporting on internal control. So the scope of the auditor's report on IC is limited to obtaining reasonable assurance that material weaknesses in internal control are identified. So that's really our task here. Take note of the terms: limited, reasonable assurance. We cannot have 100% absolute assurance to begin with. And then we only focus with material weaknesses and they have to be identified. Then there are types of opinions: unqualified, adverse, unqualified, or disclaimer. Unqualified, really there are no material weaknesses or items of weaknesses and no scope restrictions, because if there are material scope restrictions and limitations, then we have to issue a disclaimer or no opinion at all, because we cannot say that we have audited a lot or needed items have been audited properly in such audits. Then if there are one or more material weaknesses, but then again, also no scope restrictions, then that would be adverse. But if really there's scope limitation, it's either qualified. Depending on that, if the scope limitation is immaterial, we can just have that as our qualified, so except for a certain item, provided not material. And then disclaimer, if again, material scope limitations. Number 8 objective is to describe the differences in evaluating, reporting, and testing internal controls for the non-public companies or private companies. So for that, we will do the reporting. Of course, that's obvious in financial statements preparation presentation. The extent of the required IC, the extent of understanding needed, again, how deep or how Big would be our assessment and analysis, and of course, the examination prior and the procedures to be done prior. Then assessing control risk and the extent, which were mentioned already a while ago. Then this is the differences in scopes of controls tested. In internal controls over financial reporting, which is if an audit is very important, especially for accelerated filers, big or large entities which are required to have this report to ensure that internal controls are effective and efficient because they will help in making sure or ensuring that the financial statements are fairly stated, although that is an assumption. Controls that must be tested in an audit of internal controls. But if we are just going to audit financial statements and then we are not required to have the internal controls over financial reporting, so we will select the lesser testing of internal controls. So just use to assess, to evaluate also control risk below maximum. If there's a maximum level, we have to ensure, we have to make sure that the client's internal controls risks would be lower than that for us to still say that the financial statements to be prepared and presented, or that were prepared and presented, still are fair in all material respects or aspects. All right. So this basically ends our discussions for part 2. Thank you very much for listening, and God bless us